Hello and welcome to another one-to-one mining investment content session. Today we're going to be focusing on mining finance and looking at alternative sources of finance beyond the public markets. So I'd like to get started by setting the scene. While the COVID-19 pandemic has created a significant impact across all business sectors and a huge flux in financial markets, we want to hear how specialist mine finance providers are adjusting to new patterns of working and maintaining project milestones during this very restricted period. So I'd like to get going and introduce our speakers today. We're joined by Mark Sawyer, Senior Partner at Greenstone Resources, Hugh Williams, Senior Banker at the European Bank for Reconstruction and Development, Randy Smallwood, CEO of Wheaton Precious Metals. Ian Coles, Partner at Mayer Brown, will also be anchoring this discussion and is just tuning in to the session right now. So to get us started, I'd like to put out to the panel the opening question. Considering the combined demand and supply shock that the virus has created, how has this impacted capital available in the markets at present? And Mark, perhaps you could start us off on that one. Thank you.
Well, I mean, just to add a high-level comment there, I don't have the numbers in front of me, but I saw a Goldman's report this morning, which was admittedly just focusing on one jurisdiction, but nonetheless an important jurisdiction for the mining and metals space, which is Australia. The sheer number of recapitalisations that have taken place in Australia in the mining and metals space is just staggering. There's been a huge amount of capital brought in, and there seems to be a huge appetite from institution, family offices and high net worth to participate. I think there's quite a few investors missed out in the bounce in the market, in the general market, and a lot of them are looking to deploy capital and I guess participate in these recapitalizations now to make a profit. And by and large, most of them, I think it's about 70–80% of those recapitalizations are in the money, and that's over the last sort of month or so, which I guess bodes well for other markets.
On the panel? If I could just add a bit, any of the industrials, of course, anything that's feeding into the industrials, so the base metals, there's the demand side is probably one of the biggest concerns, and we've seen that in pricing in terms of the base metal pricing. But on the precious metals side, plenty of appetite out there, especially for quality projects. We've seen in North America quite a few financings, and most of them oversubscribed. And so, again, on the precious metal side, or precious metals focus, whereas base metal is hurting right now. So from an opportunities perspective, from us as a streaming company, we do see increased opportunities as a result of this. Our specialty is sort of trying to crystallize the value by becoming equity partners on precious metal streams from base metal projects. And so we've seen, it is sector specific. It is commodity specific in terms of how the response from COVID-19. But from our perspective, we've seen an increase in activity.
Hugh from EBRD. Sorry. Our part of the world is a slightly unusual geography, and we don't see that many mining deals. We are still very much open for new equity and happy to talk to people, but we haven't seen that much being raised in our part of the world yet.
And you mentioned the precious end, which of course is sort of the more buoyant one at the moment, particularly gold. Is there equity available sort of across the board, from juniors to mid-caps? Seniors probably less relevant, but is there a market for equity in the junior mining space?
We've seen that, junior all the way down to, where I would say is probably starting to get thin is the greenfields and perhaps brownfields exploration stuff that's very early stage, pre-feasibility level. That gets a little bit tougher. We've seen a couple of financings, efforts that have failed on that front, or just haven't been fully exercised. But the mid-range, and again, if you've got some decent quality ounces and good quality project in the precious metal space, we've seen strong demand in that space.
Right.
Yes.
Go ahead, Mark. You want to say something?
Right. Yeah. Just that number I was looking for. ECM trends post-COVID or post-advent of COVID. There's been 14.6 billion Australian dollars worth of raisings in April, which is the heaviest monthly issuance in the ASX history. And now, obviously, not all of that is, only a fraction of that is in the mining and metals sector. But equity capital markets are certainly not dead. If anything, they are going into overdrive.
So I was going to go. What was in the sort of private equity market? What was the availability there? Because I know that many of the funds are pretty much cashed up.
Look, I think I think availability of funds in the private equity space is still robust. I mean, we still have cash available. We've seen a large, I guess, level of interest from our investors, our LPs, around sort of co-investment. Some of them are more liquid than others, but those that are liquid are probably as aggressive as ever. At this point, if you are the consummate counter-cyclical investor, then you want to be in mining, and particularly in mining right now, because it's probably the best time to be investing. I agree with Randy's comment that the earlier stage stuff is finding it a bit tougher. But if you're in the late stage, you're at construction decision, or you're in construction, there seems to be quite a bit of appetite. I think the key challenge is going to be for a lot of people is what macroeconomic backdrop do you assume when making your capital budget decisions? I think gold is a separate case, and clearly, people as a safe haven status, has come to the fore over the last sort of 5 to 6 weeks. I guess the thing that we're struggling with a little bit, particularly on the base metal side, is it's a great time to invest, but what long-term copper price do I assume? Because pre-COVID, you'd still go about, in the good old days, 20, 30 years ago, it was an industrial supply demand, pricing dynamic. Over the last 10, 15 years, with the advent of ETFs and copper, and copper in particular, but some other base metals as well, have become an investment class in themselves. So the whole supply demand, you've got to factor in investment demand in there as well, which just made copper pricing so much more volatile than it's ever been traditionally. Put COVID on top of that as well, and just the outlook generally globally, it's phenomenally difficult to come up with a sensible price. And I'm just concerned that people are going to be driven into making more and more conservative assumptions, which means people are going to struggle. If people are using $2 copper, for example, there are very, very few projects today will get off the ground, if any. So that macroeconomic piece is something that is consuming quite a lot of our time, just trying to work out what assumptions we need to make.
We've just lost Ian there, but I'll continue until he dials back in. Randy, Hugh, thanks for that, Mark. Randy, Hugh, do you have any other comments on that macroeconomic outlook? How are you looking at budgets, and what's your take on that?
Well, I think I agree with Mark. Sorry, Hugh, I'll just step in. I agree with Mark on the, especially on the consumption side. One of the biggest impacts that we haven't really measured yet is what is the new normal going to be in terms of consumption and demand. I myself don't think we're going to get back to where we were for quite a while. And I think we've probably taken a step down in terms of consumption and demand from the industrials, for the base metals. And so $2 copper projects will not get built. There's a few in this industry that use the quote, the best cure for low prices is low prices, and the best cure for high prices is high prices. The low prices that we're seeing right now in the base metal section just means you're not going to get the project investment, and ultimately that's going to impact the supply side. I think it's going to be a while until the demand side picks up. I just, some of the more interesting stats I see, again, sort of following this theme of COVID-19, is the fact that that when places go back to work, we are seeing dramatic changes in personal choices about consumption, about travel, about getting out. You know, one of the more powerful stats for me was, you know, the fact that traffic in China, in areas where they're sort of on the backside of the curve, so to speak. Yeah, traffic during the workday is about 70 to 80% of the original normal. But on weekends, when people have their own freedom, it's still around 15 to 20% of the original normal. And so we're just going to see, I think, a change in society in terms of consumption demand, and that's going to have an impact on those industrials. And so, you know, they're interesting times. You know, we see gold as a separate entity where it's a safe haven, and other precious metals to that extent. But when it comes to the industrials, it's trying to pick off that long-term price is a very, very risky venture right now. And so I see conservatism in terms of people putting equity into it. One other aspect that I was going to add into the discussion is the fact that there are a number of companies out there that have cashed up because they want to strengthen the balance sheets and perhaps had access to capital that they wanted to crystallize. And I think some of those equity financings that Mark talked about down in Australia, you know, we've seen the same thing here where companies have decided, you know what, we're not sure what the new normal is going to be, but let's make sure we have a strong balance sheet going into it. And so we've seen a lot more activity like that in the marketplace.
Yeah, you know, and you might be right. I hope you're wrong about the demand side, but yeah, I think the positives I would throw into that conversation is the supply response in base metals has been quite dramatic. I mean, I don't have the exact numbers, but you know, it's something like 10-15% of global copper supply has been put on care and maintenance. I think the number with zinc is slightly higher. So, you know, if you just look at zinc prices, parking TCRCs right now, you know, the zinc price is sitting somewhere, you know, somewhere around the sort of 85th centile of the cost curve. With copper, it's sitting below the 75th centile on the cost curve. Now, obviously, those cost curves need to come down because energy prices are obviously falling. But you know, it's not. It was clear to me, and you know, unless global copper demand has, you know, fallen by half or something like that, you know, the current copper price isn't sustainable. And you know, if history teaches us anything, you go back to QE1 and QE2. So you go to the end of the global financial crisis, you go back to 2015, 2016 when we entered into QE2. What you saw there was a massive uptick in commodity pricing and sentiment, particularly at the end of the global financial crisis, as a result of fiscal stimulus or coordinated fiscal stimulus that was unleashed around the world. And you know, when we look around, I mean, I think commodity prices went up about 240% from the announcement over a 9-12 month period after the announcement of the start of QE1. Now, I'm not saying we're going to have, the world is a very different place than it was in 2008, 2009. China in particular, their economy has matured. Consumption is a far bigger component of their GDP than it was back then, when sort of good old fixed asset investment was something that the miners could rely upon year in, year out. You know, I think that's less relevant today, but I think that's something the Chinese are wrestling with, right? Because you know, my intelligence tells me, or sources of information tell me that, you know, China is back to sort of 80-81% of pre-COVID economic activity. You know, people working up, you know, is back to roughly 85-90% of pre-COVID levels. And I think the Chinese were assuming that there was a lot of pent-up demand in the system that would be unleashed when lockdown measures were relaxed. And I think the bit they've struggled with is that there isn't an awful lot of pent-up demand. I think people are nervous about their savings, about their futures, about a second wave of this virus biting, and are continuing to defer consumption decisions. So my view is that you're gonna, you know, the Chinese probably don't have much in order to maintain some real GDP growth. probably don't have much choice but to direct some of that fiscal stimulus into fixed asset and infrastructure, which are metal hungry activities. And I also see the Western economies like the US and Europe reshoring some of their manufacturing facilities, because I think one thing COVID has shown up is how fragile the global logistics chain actually is. And I think you're going to, there's also on a positive side, a bit of a potential for a mini boom, if I can call that, in the developed, in Europe and North America in particular, as you see some economic activity reshore to those jurisdictions. But the Chinese are relaxing some of the environmental restrictions on car emissions. I don't think there's been a policy change there, but there is certainly a lot of policy decisions being made to encourage economic activity in China, which will affect metal consumption ultimately.
Yep.
I think from my perspective, we obviously don't know the near-term future of COVID, and there's a lot of uncertainty. But long-term, we're certainly bullish on copper, and we see prices going up significantly from current levels due to the supply and demand on the mine side, and the impact of things like electric vehicles and renewable energy coming in.
Yeah.
Do you have any views on the Chinese outlook and sort of how that's impacting your thoughts on recovery out of this, or the economic performance perhaps in Europe where you're looking at projects?
I think there's some Western rhetoric right now about don't believe the data coming out of China. The death rate, is these guys are responsible for the virus, etc., etc. To be honest with you, I'm a cynic about some of those headlines. Frankly, I think the Chinese response to the virus was far more brutal, if I can put it that way. And included measures which just would be utterly unacceptable in a Western democracy in terms of their infringement on civil liberties. And I think the death rate in China, history is going to prove, was much lower than it is in the US or elsewhere in Europe, because they were able to take more decisive action more quickly and, dare I say, infringe on so-called civil liberties. I think that puts the Chinese in pretty good shape. They're a couple of months ahead of the rest of us. I think there are concerns about their ability to export their way out of this. Clearly, the Q1 GDP numbers were pretty depressing. Consumption, as I just said before, it seems to be still lackluster. So I think the Chinese, to maintain social stability, are going to have to invest in more hardcore industrial activities, whether it's investment in bridges, trains, or whatever it might be. But if you watch the news flow, there seems to be a slow and steady growth in a central government and regional announcements that will all lead to increased demand in metal. So my view over the next 12 months is that China could be a bit of a bright spot from a mining and metals perspective, that you're going to see increased demand from China.
Randy, any thoughts here? Any thoughts on China again?
Well, they definitely have the advantage, and there's no doubt. Here in Canada, we get way too much of the rhetoric out of the United States, which is where a lot of that anti-China is coming from. We can't forget this is an election year in the States, and I don't think we've heard the end of it, and I think it's going to get even stronger and stronger over the next while as we've got a leader down there that's going to try and point the finger as much as he can to all the challenges in the world being someone else's fault, and so it's a pretty key factor, I think, that's going to come in. I do think that one of the results we're going to wind up seeing here, though, is and we already had the groundwork for this before this pandemic started, is trade issues, trade block issues where it's just going to be tougher and tougher to have wide open free global trade, and challenges along those lines. And so China, of course, painted as a pariah by this American administration right now, is going to struggle on the export side. But this is what we're seeing, and this is why I'm so bullish on precious metal prices, is that every country in the world is going to try and spend their way out of this. I'm hopeful that there is a real push towards and I think in the mining industry we've seen a number of projects that have hit sort of roadblocks or stalemates or slowed down dramatically by regulatory burdens. And I'm hopeful that one of the benefits that comes out of this whole battle that all these countries are facing is that there's a few projects out there that shouldn't be moved forward, that that have been sort of stagnating in permitting hell, that may all of a sudden get a kickstart because host countries will be doing everything they can to try and stimulate economies. And so I do think that there's going to be a push in that direction. Again, there's no doubt there's going to be recovery from where we are right now. It's a matter of whether it gets back to where we were pre-pandemic, or whether it's going to settle in at about 80 to 85 or 90% of where we were, and then gradually continue our growth. We're driven as a society to continue trying to improve the lives of everyone around the world, and that just means that there will be consumption, because as poverty on a worldwide basis decreases on a relative basis, that just drives consumption. It's really consumption, and so there's it will return to there. It's just going to be a matter of time, and I just don't know if we'll ever hop back to the profile that we would have originally had. I think this is going to wind up being essentially a setback of about a year to year and a half. And people are going to be cautious. Consumption rates aren't going to be as high. So,
yep. So potentially fiscal spend to bring us out of this, but a long lag to get back to anything near how it was. Hugh, do you have any other comments on that point before we switch on to another topic?
I just saw, I think it was Wood Mackenzie put out a study showing that there's been big demand destruction this year, but essentially the long-term growth rates are likely to be similar to pre-COVID levels. So you end up with this shortfall in demand that carries forward indefinitely because you've lost a year this year. But yeah, we see growth.
Yep. Okay. Well, we've covered a lot on the markets and the state of where things could be headed, or how we might get out of this crisis. What about the juniors? What about the mining companies at the minute? What are you hearing from your portfolio companies, and also how do you think they've adapted at the moment? I think certainly it depends what sort of commodity you're in. You could say the Newmont and the sort of larger precious metals miners are looking very, very healthy at the minute. Ian's just rejoined us actually. Seems to have got a better connection. I'll just admit him, and then I'll reiterate the point. But yes, if we could jump on to talking about how have the mining companies responded that and also perhaps what would be your advice for the mining companies going forward in this next short-term period? What are you advising? Hi Ian, welcome back.
Sorry, our internet went down.
Okay, the new technical risks. Yeah, so we're just jumping onto a point. We've done sort of some macro analysis, and now we're moving on to how are the mining companies looking? How are the juniors looking? How are the majors looking? And what should they be focusing on at the minute? So I'll hand it back over to you, but let the gentleman respond. Thanks.
I think it's. I wouldn't have the arrogance to suggest what Rio Tinto and BHP should be doing, but just focusing on the junior end. Look, this has been a quite surreal experience, I'm sure, for everybody on this call. There were periods over the last 6-7 weeks where things were changing so quickly. There were consequences that were flowing from COVID on the ground, which were just unimaginable at literally days, not weeks, but days before they materialized. And look, we're still all alive. We're still on this call. It's been a very tragic event. I think the junior sector has, by and large, coped pretty well with it. I think if you're a junior company with pre-production, with a project or projects, and you had some cash, I think the priority and our advice to everyone 6 weeks ago is just batten down the hatches as fast as you can. Make some very, very hard decisions about deferring all non-essential work streams other than ones required to preserve option value, and just try and weather this storm out. And I think, if you are a project company that was able to do that, then you're able to survive. So I think looking across our portfolio of 13, 14 companies, the ones that have projects in pre-production, they're all fine because they've got us, on the register. They're by and large reasonably cashed up, and all of them will survive into well into next year before needing to raise more money. I think if you're in production and you're still able, particularly if you're in gold, which is a far less capital intensive industry, it doesn't need the huge amount of infrastructure that, say, an iron ore or a bulk commodity business needs. Again, if you're profitable, which most gold companies should be at these gold prices, then happy days again, right? And I think that's reflected in a lot of the valuations out there. I think the really difficult spot, and we've got a couple in this in this category. Either you are mid-construction, or you've completed construction and you're in ramp up of your project. I think doing that in this environment where you've got a construction schedule and a very high holding cost for your project, but that construction schedule is now under threat because not all contractors can be on site at the same time because of social distancing and the like. Due to restrictions on international travel, if you're reliant on overseas contractors or whatever the case may be, that is a very vulnerable place to be in. But we've got a couple of those, and my sense is, this is a time when it makes a lot of sense to have a strategic, the much maligned private equity cornerstone shareholder. If you've got a supportive one, then this is when we come into our own, right? Because we provide the sort of long-term support that those companies need, and the equity capital markets in places like Australia seem to be stepping up to the mark as well. So I think we'll get through them. It's just a really complex situation to be mid-construction and suddenly have COVID thrown at you is, as I say, just very, very difficult.
Yeah. So from our side, the portfolio that's in production is indeed doing very well, thanks to gold. We don't have anyone in the middle of construction. What we're seeing at the earlier stage is people working on feasibility studies are experiencing some delays because of working from home, because consultants can't always do things as quickly as they'd wanted. So some companies, I think, will need to stretch their money another few months to get to PFS or BFS, and then be in a position to go out and fundraise. So I share the comment that they need to be minimizing all the other costs.
Yeah, if I could just add, I mean, it's times like this that the value of equity partnerships, either by shareholders or by streaming in terms of investing into it, really stands out. If you're dealing with bank debt and in mid-construction right now, your shareholders are at serious risk in terms of how that project's going to look post-COVID or even living with COVID in terms of working its way through. And it's and I think that's one of the big attractions about the form of investment that we're talking about here, which is as an equity partner. Even streaming, we're an equity partner. We ride these things whether they whatever the percentage is. And so I think that's one of the it's times like this that the strength of that kind of support really stands out. And that's, I would echo the same advice all the way across the board. If you're at pre-feasibility still sort of hammering that out, you pull it back in. If you don't have cash flow coming in, you pull back in your resources and get prepared to weather a bit of a storm going forward. If you're mid-construction, I hope your project is robust enough to survive the new commodity price regime for a while. And if it is, you shouldn't have any problem moving forward, especially if you have strong supporting equity partners or shareholders that are backing these projects.
But actually, Randy, I would say though, in my experience, this is where actually it bifurcates some of the lenders. I think some of the more traditional lenders out there that we deal with have behaved in a really supportive, pragmatic, and constructive way. And I include some of the sort of, this kind of quasi state lenders and some in that group. They clearly recognize the enormity of the situation. It's unusual. I think where we've experienced perhaps some of the more inflexible behavior is with alternative lenders that are a little bit more aggressive and predatory. As you say, the whole existence of the project then is then called into question if you can't get some form of forbearance. I mean, just simple things like forbearance on interest or principal repayment or some form of rescheduling of debt, whatever it might be. We're all in this together, and it's going to require lenders also to share some of that pain. And I've been pleasantly surprised with some of the behavior of some of the lenders, but as I say, alternatives just a little bit more challenging.
Yeah, I echo those comments. Flexibility. I've had experiences in the past in this industry where when it comes down to lenders in a pure sense, boys, you start breaching covenants. There's a certain amount of capacity, a certain amount of flexibility, but if you start breaching covenants on a consistent basis, that's not the side you want to be. You'd rather be there with an equity partner that stands beside them all the way through the whole project. So that's the side that gives, from a shareholding perspective in terms of what you own and what you're investing into, that is really where you want to have that backstopping as you're trying to build your company and trying to go forward.
Mark, I know you mentioned the sort of quasi-state lenders in your previous comment. Wonder about the role. I mean, a lot of deals that we see now, new ones coming along, have got ECAs, DFIs, in those deals. And I was wondering what people's view is of their role in deals going forward, because in a way their time has come. I know we got Hugh here. I don't know whether or not so he has a view on that.
Yes, we very much see this as EBRD's time. So we've already announced 2 billion of extra finance for existing clients who need it. And we will be doing a lot more in the future as well. So we fear that the commercial banks will be hit by non-performing loans and people asking for moratoria. So we expect to be doing more financing rather than less. And we're also setting up a streamline proposal so that people who need a rescheduling can get one fairly quickly and fairly painlessly. That's on the debt side. On the equity side, we are very much open for business. We expect to see more sort of structured finance coming because of people perhaps not wanting to take the valuation hit. But I think mining, even there, we can probably consider pure equity because most companies are listed and the prices are easily available.
I don't know, Mark, have you sort of seen any evidence of that?
Mark's
I think he now dropped off.
No, sorry, I just I put it on mute. Someone was knocking at my door.
Okay.
Part of the perils of working from home.
Right. People arrive. Yes.
Yeah,
unexpectedly.
Exactly. No, look, I mean, I very much concur with everything Hugh just said. We've had some direct exposure to or indirect exposure to national Australia infrastructure, NAIF, incredibly supportive. Maybe they have some political agenda there to support Australian projects, support Australian jobs, but just incredibly supportive and constructive behaviour. Same with KfW, in Germany, again, just very pragmatic and supportive. I think with the commercial banks, I think Hugh's right. There is a risk of non-performing loans, and I think so if you are a aspiring producer that was hoping to close your first project financing with a commercial bank next month, then unless you have an absolute barnstormer of a project, I think you're going to struggle, because I think commercial banks will be focusing their firepower on, and Hugh used this word, existing relationships. Who are their existing clients, and look across their loan book to see the performing and the non-performing ones, and seek to, if there is to be financial accommodation, then you do it with your existing client, because it's much easier to do that than take a new opportunity to your IC or others.
Right. I mean, we're working on several RFPs at the moment which have got commercial banks in them, but they all seem to have slowed down. But there's sort of some couple in Brazil actually in particular which just seem to be going ahead. So I think you must be right. If you've got a barnstormer of a project, then you're probably going to be okay. How about, I don't know whether or not you spoke about this when I was offline, sort of M&A is a solution to some people's travails. We've seen sort of Endeavour and Samarfo. I guess Guyana Goldfields is subject to a takeover. How do you think that's going to sort of play out over the next year or so?
Look, I think there's a lot of counter-cyclical buyers out there, and we've certainly seen an uptick in inbound interest in our assets. But is it pure coincidence that coincides with a collapse in the share price valuation? I think not. And so I think, there's going to be a lot of people. If you compare this to the last 2015, 2016, commodity prices had been falling. The difference is then the whole sector was pretty leveraged up, and there were times when Rio Tinto itself, mighty Rio Tinto, was under pressure. Glencore was over levered. I remember its share price falling to, what was it, 80p or something at its at the lowest point. I think the difference is now with this crisis is that the sector, the financial health of this sector is in far better shape than it was in 2015, 2016. Overall leverage is lower. Some progressive dividend policies have been reinstated from some companies. I think some companies are sitting on cash piles and looking what to do with it. And I think, at a time when there's been very, very little M&A outside of gold, really, over the last sort of 5-6 years. And I think those companies will be looking to this next 12 months as an amazing opportunity for them to buy assets cheaply. But, question is, how desperate are people to sell?
Yeah, I would add in just that opportunistic moves is what we're going to see. The volatility that we've seen in commodity prices over the last 6 months is something that's going to play into this. If someone's a little bit more optimistic in terms of where they feel copper prices are going to go, then that project that doesn't look too attractive at $2 or $2.20 a pound maybe an attractive target for acquisition. If so I mean, I really do think that kind of volatility is just going to feed into opportunistic moves in the space where someone decides to take a run at, and there will be things like Guyana Goldfields and Samarfo that actually cross the line and get into that M&A level. Anytime you see volatility like this, I think you see an increased opportunity for M&A.
Personally, I would expect less M&A. I think the COVID impact is so uncertain, and people are worried about the long-term impacts and whether there's going to be future waves. So it would be a pretty brave board to go out and spend a lot of money today. I think people will be sort of hoarding cash to see how things turn out. Obviously, there could well be opportunistic, small acquisitions from distressed sellers, but overall I would expect the total level to go down.
And do you think there's debt or other money for M&A, or are there mostly going to be share deals that do occur?
Well, I think, you know, I personally think probably a mixture of both, but I think if you wanted to be opportunistic now, you'd be using cash to buy cheaply rather than your undervalued scrip to buy assets. That's what I would be doing. But you know, you probably see a mixture of both. But you know, it depends on your register as well and how desperate the sellers are. I think, you know, we're not desperate to sell anything. We're long-term holders of the companies that we back. So, you know, whilst we welcome, obviously, the increased interest, and, you know, there has been a lot of increased, you know, inbound calls asking to look at data and things like that over the last 6 weeks. We're definitely not sellers at these sort of prices. We're going to need to see a recovery in the sector before we even contemplate selling some of our portfolio investments.
Yeah, I would say we've had a number of outreaches from people looking for partners on the M&A side, and so, you know, where we would actually supply some of that capital to go forward to combine with the scrip. Cash is, of course, I agree. If your stock is trading at a you know, at a lower valuation than you expect, and you've got the cash available and it's not going to stress your own balance sheet, that's the best way to pay for this going forward. But we have seen a pickup in reach out just from potential partners on standing beside them during an acquisition and helping fund that, and we're typically will supply the cash and something like that, and they and a, you know, combination of cash and equity, we'll supply the cash and they'll supply the equity in terms of that. So we have seen.
I think where the opportunity sits is maybe take private strategies are probably relevant right now.
Mm-hmm.
You know, if you're already in you know, some of these companies, then it's a great opportunity to you know, to take private at fairly low valuations.
Yeah.
And Mark, you sort of mentioned the PE funds. I mean, there seems to be a lot of unspent firepower in a bunch of the PE funds. How do you think that's going to play out over the next year or so?
Well, I think a lot of funds see this as an opportunity, which you know, Hugh obviously agrees with. You know, it's your time, I think you said, and Randy similarly. I think, you know, people are going to pause. You know, decisions which may have been made 3 or 4 weeks ago, I think people are just going to pause to see how things pan out. You know, you are going to see some bottom feeders appear, unfortunately. But you know, this is a time to be investing capital, right? It's a fantastic opportunity because the world hasn't come to an end. You know, it's been a tragic sequence of events, and clearly all of us feel that. But economically, the world hasn't come to an end, and it may take a year, it may take 18 months, but that demand is going to come back. And the supply shock that has happened, the amount of projects that are getting deferred, the amount of production that is going care and maintenance, means that when the market, to my mind, when the market does turn, it's going to turn quite hard and quite fast, because the supply won't be there to be just simply turned back on again. Adam, I need to ring off now, unfortunately. So as I said, I'm 2 minutes late for something else. So apologies, I must ring off. But good to see you all healthy and well.
You too, Mark.
All right, take care. Bye-bye.
All right. Is that a wrap, Adam, or do you want to keep on going?
Adam, you're on mute.
You're on mute.
Because we started a bit late, guys, we have 5 minutes. If you wanted to wrap up with any final thoughts in, if you had any final questions to put to the guys.
Well, I've got one more question. We sort of see China possibly coming out the other end of this crisis. Do you think they're going to have a role to play in the sort of global chase for capital in the mining world over the next year or so?
Yeah, I mean, if I would just add in, you know, other than the fact that I think there's going to be you know, and albeit there's a lot of rhetoric out of the United States about China and the danger of China, and that's probably going to limit some of that. But, you know, I mean, I think what we're going to see is a lot of countries around the world just quantitative easing. There's going to be a lot of capital put in to try and restart economies, and China's probably going to be one of the more aggressive ones in that space in terms of trying to kickstart and try and get back to a new normal. And so, you know, I do think that's they've got a head start, I think, on the rest of the world in terms of trying to get that going. So,
in terms of the countries where we invest, we see a lot of Chinese projects and money in places like Mongolia, Kazakhstan, Serbia. Historically, it seems that Chinese-owned projects are financed by Chinese banks. We tend not to see that much Chinese finance coming into other projects yet, but I understand that does happen in places like Africa.
Yeah, we see quite a lot of it in Africa, though it's been quiet for a while. But I suspect it's going to come back, particularly in some of the more challenged jurisdictions. I don't think we've got anything sort of more really by way of questions. I mean, I don't know if you and Randy, you want to sort of give some summarizing thoughts. I mean, sort of COVID again is the elephant in the room, but it seems from the discussion on this panel that there continue to be opportunities in the mining world. People have got to hoard their cash, bide their time, but long term, there are opportunities here for people. I don't know what your concluding thoughts are.
I'll go first. You know, this is a time. You know, there is a light at the end of the tunnel. There will be a new normal. We will get through this as society, as humanity always has. And so this is the time that I think longer term vision is a requirement. But you also have to make sure that you've got everything in order on the short-term basis, and take action if you haven't, in terms of making sure you've got a strong enough balance sheet, no matter what stage your company, your project, your team status is at. You just have to make sure you have everything in order to survive through what I think is probably going to be some short-term volatility, but in the long run, you know, if you've got a good quality project, a good quality portfolio, this is, and if you've got the capacity, this may be a time of opportunity in terms of you know, building on that and growing on that. So you know, just make sure you've got a firm foundation.
Yep.
Yeah. I think in our portfolio, we see mining as relatively less affected than many other sectors, such as property and tourism, restaurants, and so on. Short term, you know, possibly even beneficial, arguably, for gold. The price has certainly shot up, and if there is a lot of government printing money, and you know, QE, whatever we're up to now, I think you could see gold going much higher. And you've had analysts talking about $2,000 or $3,000 gold. Medium to long term, we see this as a shock to the system, but we do expect long-term recovery, and therefore we're still happy to consider base metals as well, things like copper. We see a positive long-term outlook.
Very good. Well, thank you both, and also thanks to Mark, who had to depart for a call. Adam, sort of pass back over to you. I don't know if you've got any sort of concluding thoughts as well.
No, thanks very much for that, Ian, and thanks everyone for your time. We're just hopeful that things can keep ticking on and we can continue to add value to the market and the investors and the mining companies that we work with, and hope that this is you know, a period where people look to hard assets and to mining and to metals, and the fiscal spend sort of is what's needed to bring us out of this economic slowdown.